Over the last few months, everyday retail traders have flooded back into the stock market. Since mid-April alone, retail trading volume has spiked by 28%. That capital is flowing in a single, highly concentrated direction. Investor exposure to the tech sector has reached its highest level since January of 2024, driven by a belief that everything AI is a guaranteed winner. Now, billions in cash are lining up for the upcoming SpaceX initial public offering. While it's an aerospace company, it's becoming a massive AI play through its XAI division, which recently struck a multi-billion-dollar deal to lease data center capacity to Anthropic for AI model training. This frenzy is being turbocharged by a change in the rules. With pattern day trader margin requirements relaxed, everyday traders are suddenly able to tap into unprecedented amounts of leverage to chase these hardware-heavy tech plays. Retail investors are acting as if the market is invincible, apparently unaware that a very different kind of behavior is emerging among the people who actually run the system. While the retail crowd is buying the AI future, high-level political and financial insiders are behaving with a sense of frantic urgency. Donald Trump's personal account offers a look at this disparity. During the same period that retail has been holding steady, Trump's account executed a staggering 3,700 stock trades in a single 90-day window. Breaking that math down reveals a rate of roughly 37 trades every single day. This mimics the behavior of high-frequency day traders, suggesting a high-stakes effort to navigate volatility rather than a belief in long-term stability. At the same moment retail traders are leaning into leverage, political insiders are liquidating and rotating at a pace rarely seen in modern history. This insider rotation aligns with recent warnings from Citi and Goldman Sachs, who have begun alerting clients to what they call tech fatigue. We saw this play out with Applied Materials. Despite crushing their earnings reports and beating expectations, their stock price stalled out. The market simply refused to push the valuation higher. This stall is happening because the ultimate corporate safety net, the stock buyback, is quietly disappearing in the tech sector. The Q1 data shows a massive imbalance. Corporate buybacks grew 1%, while capital expenditures surged 38%. Big tech is incinerating cash on physical AI infrastructure, spending on chips and cooling systems, instead of propping up share prices. Without corporate buybacks acting as a foundational floor, the current tech rally is running almost exclusively on retail momentum, leaving it vulnerable to any shift in sentiment. That vulnerability is now being compounded by the Department of Justice, which has launched a targeted investigation into the private credit market. The probe follows a shock from BlackRock's TCP fund, which suddenly wrote down its asset values by 19% in a single month. This raised a red flag for regulators. If one of the world's largest managers was off by 20%, how many others are as well? The risk is hidden behind a legal structure known as Regulation D. Regulation D allows venture capitalists and private funds to invest in companies without ever publicly reporting their audited financials. It creates a black box where companies can receive billions in investment while their actual health remains a secret to everyone but the fund managers. Because these funds use similar, non-transparent valuation practices, the DOJ investigation puts the entire sector under the spotlight. If regulators find these errors are systemic, it could force funds across the industry to finally reveal the true lower values of their holdings. While the internal mechanics of credit are under fire, broader global pressures are squeezing the market from the outside. Geopolitical friction is mounting. The lack of trade progress with China and rising tensions with Iran have driven the US dollar higher. For American tech companies, a stronger dollar makes their products more expensive abroad and eats into their international earnings. The most immediate pressure, however, is in the bond market. 10-year and 30-year Treasury yields are threatening to break the psychological 5% threshold. A 5% yield on government debt acts as a historic ceiling for stocks. When investors can get a guaranteed 5% return from the government, the incentive to gamble on high-leverage AI stocks begins to vanish. We are looking at a market held up by retail traders using record amounts of leverage, while the institutional supports, from buybacks to private credit stability, are showing clear signs of strain. At the same time, the AI cycle is hitting its limit. Crucial data center components are now on backorder for up to a full year, meaning the rapid expansion of hardware is slowing down. This timing suggests that the SpaceX IPO and its massive AI-driven data center deal with Anthropic will likely represent the moment when the last major flood of capital enters the space. Once that hardware hype peaks, capital will likely begin a predictable rotation. Money will move away from overheated hardware manufacturers and start flowing into the sectors that have been lagging behind. Chasing the leveraged everything AI trade at these levels ignores the systemic warnings being telegraphed by insiders. The more stable play is preparing for the rotation into software and finance before the retail momentum finally meets the reality of the credit market.